SA200 Overall Objectives of an Independent Auditor and the Conduct of an Audit in Accordance with Standards on Auditing. Overall Objectives of the Auditor. While auditing the financial statement, the auditor has following objectives: to obtain reasonable assurance about whether the financial statements are free from material misstatements, thereby enabling the auditor to express an opinion on whether financial statements are prepared as per applicable financial reporting framework, and to report on the financial statements and communicate as per SAs. If reasonable assurance cannot be obtained and qualified opinion is insufficient, then as required by SAs, auditor should either disclaim the opinion or withdraw from engagement. Ethical requirements. If the auditor is subject to relevant ethical requirements, including those pertaining to independence, relating to financial statements, audit engagements. Relevant ethical requirements ordinarily comprise the Code of Ethics issued by the Institute of Chartered Accountants of India. The code establishes the following as the fundamental principles of professional ethics relevant to the auditor when conducting an audit of financial statements, and provides a conceptual framework for applying those principles: integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. In the case of audit engagement, it is in the public interest and therefore required by the Code of Ethics that auditor be independent of the entity subject to the audit. The code describes independence as comprising both independence of mind and independence in appearance. The auditor's independence from the entities safeguards the auditor's ability to form an audit opinion without being affected by influences that might compromise that opinion. Independent enhance the auditor's ability to act with integrity, to be objective, and to maintain an attitude of professional skepticism. Now, second point, professional judgment. What is professional judgment? Professional judgment is essential to the proper conduct of an audit. This is because interpretation of an relevant ethical requirements and the SAs and the informed decisions required throughout the audit cannot be made without the application of relevant knowledge and experience to the facts and circumstances. Professional judgment is necessary in particular regarding decisions about materiality and audit risks, nature, timing, and extent of audit procedures used to meet the requirements of the SAs and gather audit evidence, evaluating whether sufficient appropriate audit evidence has been obtained and whether more needs to be done to achieve the objectives of the SAs and thereby the overall objectives of the auditor. The evaluation of management judgment in applying the entity's applicable financial reporting framework, the drawing of conclusions based on audit evidence obtained, for example, assessing the reasonableness of the estimates made by management in preparing the financial statements. Preparation of financial statements. In that we can write, audit is conducted on the premise that management and TCWG have some fundamental responsibilities. Audit of the financial statement does not relieve them of their responsibilities. Now, what is purpose of an audit? Number one, to enhance the confidence of intended users of the financial statements, to form an opinion on the true and fair view of the framework. Number three, his opinion does not assure future viability of entity or efficiency or effectiveness with which the management has conducted the affairs of the entity. Number four, however, in some cases, applicable law or regulation may require auditor to express opinion on some specific matters. Then auditor should undertake further work. Now, reasonable assurance. What is meant by reasonable assurance? We can write, the audit of financial statements does not relieve management or TCWG of those responsibilities. The auditor's opinion, therefore, does not assure the future viability of the entity nor the efficiency or effectiveness with which management has conducted the affairs of the entity. Reasonable assurance is a high level of assurance. It is obtained when the auditor has obtained sufficient and appropriate audit evidence to reduce audit risk. That is, the risk that auditor expresses an inappropriate opinion when the financial statements materially misstated to an acceptably low level. However, reasonable assurance is not an absolute level of assurance because there are inherent limitations of an audit which results in most of the audit evidence on which The auditor draws conclusion and bases the auditor's opinion being persuasive rather than conclusive. Now, inherent limitations of an audit. As per SA200, overall objectives of the independent auditor and conduct of an audit in accordance with standards on auditing, the auditor is not expected to and cannot reduce audit risk to zero and cannot therefore obtain absolute assurance that the financial statements are free from material misstatement due to fraud or error. This is because there are inherent limitations of an audit. The inherent limitations of an audit arise from the nature of financial reporting. The preparation of financial statements involves judgment by management in applying the requirements of entity's applicable financial reporting framework to the facts and circumstances of the entity. In addition, many financial statements items involves the subjective decisions or assessment or a degree of uncertainty, and there may be a range of acceptable interpretations or managed judgments that may be made. Number two, nature of audit procedures. There are practical and legal limitations on the auditor's ability to obtain audit evidence. For example, there is the possibility that management or others may not provide intentionally or unintentionally the complete information that is relevant to the preparation and presentation of the financial statements or that has been requested by the auditor. Fraud may involve sophisticated and carefully organized schemes designed to conceal it. Therefore, audit procedures used to gather audit evidence may be ineffective for detecting an intentional misstatement that involves, for example, collusion to falsify documentation, which may cause the auditor to believe that audit evidence is valid when it is not. The auditor is neither trained as nor expected to be an expert in the authentication of documents. An audit is not an official investigation into alleged wrongdoing. Accordingly, the auditor is not given specific legal powers such as power of search, which may be necessary for such an investigation. Timeliness of financial reporting and the balance between benefit and cost. The matter of difficulty, time or cost involved is not in itself a valid basis for auditor to omit an audit procedure for which there is no alternative. Appropriate planning assists in making sufficient time and resources available for the conduct of the audit. Notwithstanding this, the relevance of information and thereby its value tends to be diminished over time, and there is a balance to be struck between the reliability of information and its costs. Other matters that affect the limitations of an audit. In the case of certain subject matters, limitations of the auditor's ability to detect material misstatements are particularly significant. Such assertions or subject matters include fraud, particularly fraud involving senior management or collusion, the existence and completeness of related party relationships and transactions, the occurrence of non-compliance with laws or regulation, future events or conditions that may cause an entity to cease to continue as going concern. Note: due to aforesaid inherent limitation, there is an unavoidable risk that some material misstatement may remain undetected. Now, next point is professional skepticism. In this, we can write professional skepticism refers to an attitude that includes a questioning mind, being alert to conditions which may indicate possible misstatement due to error or fraud, and a critical assessment of audit evidence. The auditor shall plan and perform an audit with professional skepticism, recognizing that circumstances may exist that cause the financial statement to be materially misstated. Professional skepticism includes being alert to, for example, audit evidence that contradicts other audit evidence obtained, information that brings into question the reliability of documents and responses to inquiries to be used as audit evidence, conditions that may indicate possible fraud, circumstances that suggest the need for audit procedures in addition to those required by the essays. Maintaining professional skepticism throughout the audit is necessary if the auditor is to reduce the risk of overlooking unusual circumstances, overgeneralizing when drawing conclusions from audit observations, using inappropriate assumptions in determining nature, timing, and extent of audit procedures, and evaluating the results thereof. Now, what is applicable financial reporting framework? In this we can write the financial reporting framework adopted by management and where appropriate those charged with governance in the preparation and presentation of financial statements that is acceptable in view of the nature of the entity and the objective of the financial statements or that is required by law or regulation. The term financial reporting fair presentation framework is used to refer a financial reporting framework that requires compliance with the requirements of the framework and acknowledges explicitly or implicitly that to achieve fair presentation of the financial statements it may be necessary for management to provide disclosures beyond those specifically required by the framework or acknowledges explicitly that it may be necessary for management to depart from a requirement of the framework to achieve fair presentation of the financial statements. Such departures are expected to be necessary only in extremely rare circumstances. The term compliance framework is used to refer to a financial reporting framework that requires compliance with the requirements of the framework but does not contain the acknowledgements. In India, now what is conduct of audit in accordance with SAs. In this we can write the auditor shall comply with all SAs relevant to the audit. The auditor shall have an understanding of the entire text of an SA, indicating its implications and other explanatory material to understand its objectives and to apply its requirements properly. The auditor shall not represent compliance with SAs in the auditor's report unless the auditor has complied with the requirements of the SA and all other SAs relevant to the audit. The auditor shall comply with each requirement of an SA unless in the circumstances of the audit the entire SA is not relevant or the requirement is not relevant because it is conditional and the condition does not exist. If an objective in a relevant SA cannot be achieved, the auditor shall evaluate whether this prevents the auditor from achieving the overall objectives of the auditor and thereby requires the auditor in accordance with the SAs to modify the auditor's opinion or withdraw from the engagement. So this is all about SA200.